What do tariffs mean for Canada's stock market? Should you be worried about a stock market correction? And why is gold outshining tech stocks? Those are this week's market moves. Let's dive in. All right, let's start with tariffs. Tariff terror has been rattling the markets recently, but the impact on specific stocks is still open to debate. Now, Bloomberg Research has found that companies that ship physical goods and materials outside of energy to the United States actually carry a relatively small weight within the broader Canadian stock market, and that could potentially limit the impact on Canada's stock market overall. Meanwhile, for companies that do have cross-border operations, it doesn't necessarily mean that they are constantly shuffling products across the border. We had a conversation with the CEO of Jamieson Wellness, big vitamin maker, who noted to us that the company's products in the US are distributed through their facilities there, and in Canada, the products are made here and distributed here. Oh, by the way, which US company has the most Canadian exposure? According to Bloomberg Research, Costco. The retailer generated an estimated 14% of its revenue from Canada last year. But again, the cross-border impact is debatable. According to the Bloomberg Research, Costco uses domestic suppliers in Canada to stock its more than 100 warehouses here. Now, all that said, investors have looked a little uncertain recently given the volatility, but according to market experts, it is quite normal to see a pullback in stocks even if you're in a bull market. Data from Ned Davis Research, this is an investment research firm, has found that on average, you do see the stock market correct, a correction being a decline of at least 10%, not exceeding 20%, every 1.1 years, going all the way back to 1928. And so if you look at where we are in the current bull market, we've actually gone longer than normal without seeing a material pullback. Finally, as tech stocks have been struggling, gold has been shining bright. And that's a divergence longtime investor David Burrows expects will continue. David's with Barometer Capital Management, and he noted to me that from 2002 to 2011, gold routinely outperformed the NASDAQ 100 index. But from 2011 to 2022, the NASDAQ 100 easily outperformed gold, which basically had no return. And so he sees gold as being an under-owned asset despite the recent rally. In fact, he wouldn't be surprised to see a steady advance in gold for the best part of the next decade. All right, those are our market moves for this week. What market moves are you watching? Let us know in the comments. Don't forget to like and subscribe, and we'll see you next week.